Hello guys, you are welcome to my channel once again. It's me a while that I uploaded a video. I've received a lot of messages, people asking me how I trade, how I enter the market and all those stuff. So I decided to make this video to address all those questions. Um Before that, I would like you to subscribe to my channel if you have not, because I'm gonna release so much knowledge and insights that will help you take your together. So let's get into the video. Now, for you to be very, very successful in this market, you have to understand or know how the market works and also how how institutions also go about their trades, because they are the big players in the market. So if you're able to follow them or know their footprints, that will help you very, very well in your trading. So in this video, I'm going to release so much secrets that I use to get such trades and then to get high probable trades. So are we talking about how the banks use liquidity pools and inefficiency to execute their trades? The only way that they can enter the market is when they have there are a lot of liquidity in the market. So they target those zones. That's the factor highs and lows. Some also call it swing highs and lows. That's where they target to place their trades. And whenever they enter, they execute their trades, it causes inefficiency in the markets because of their high volume that they create in the market. So after liquidity pool sweep, we have to confirm the volume that will come to the markets using other blocks and fair value gap. I'll go into details, and also we look at market time cycle. Yeah, actually, there are a lot of misconceptions that we're all following. I was also following some that the markets operates on Monday and close on Friday. Yeah, it's very true, but the institutions or the big players actually place their trades on specific days, which is Wednesdays and Fridays. Now, these 2 days actually create CRT, which is the candidate theory. We go into details. Then also I'll talk about my model. So I would like you to grab your notebooks and your pen, because I'm going to release a lot that will help you. Now we talk about inefficiency and liquidity pools. So now this is what happens in the market. Whenever the institutions want to enter the trades and execute their trades, now because they have a large number of fields to execute, if they are buying, they have to get sellers. Now they have to go to where there are a lot of liquidity that will match their trades. Now liquidity lies or can be found at swing highs and lows. Now this point is where those who are selling this market, they probably put their stop loss above here, and some too are looking up to buy it when the market gets to this zone, which is the breakout traders. They also trying to catch this buy when it comes here. So now what happens here is that there are a lot of liquidity here, which is people are trying to buy here, and people too are placed their stop losses above here. So this is what the institutions will do. What they'll do is they'll push price up, grab everything here, and then use the liquidity to enter their trades. Now this is very, very simple. This is simple. Institutions have to bring price up here, take all those money here or liquidity over here, which is in the form of stop losses, and then buy stop orders. They will take all of them here, and then they will sell the. And this leads us to our second subtopic, which is below confirmations. Now, after they've taken their trades, what happens is that there is a sudden movement in the market which causes inefficiencies in the form of order blocks and then fair value gaps. So you could see that after the 2 days high, now price moved up above this high, clear off all these stop losses, and then buy stop orders here. Then price was dropped. Now what happened is that you can see that after they clear the stop, orders here, now price moved aggressively down. Now this aggressive down movement caused what fair value gaps here, caused a fair value gap. And then this is your order block. The last candle or the candle that causes the red. When that candle is displaced, that candle becomes your order block. I want you to take this very because this is how to enter the market too. You can see that this candle, the one that I've highlighted here, is the one that caused the suit, which is that peg this high, which is the fractal high over here. Now, when this candle is displaced, it becomes our order block. Whenever price trades into this order block or this zone, you can sell from it there. This number one. Number two is that after the liquidity sweep, other fair value gap was formed over here. So when price trades into this fair value gap, you can sell from here too. Why? Because their orders are so much, we're not able to get much buyers here to match their sell. So it will create what inefficiency, which is in the form of fair value gap, that when price trades into it, it will drop from there. So now this is one way or one criteria that you can use. Now you can use this as your entry model, or you can also use it to as your bias or your direction. Now this is the basis of 30 soup and all those soup stuffs. Now when you get this, because you are aware that there are stop orders over here and price as what peg all these eyes. Now when you see aggressive move like this, it means that the big players are behind this move. So now when you see this, what you have to do is just wait for that candle that did already be displaced. And when that candle is displaced, it means that your order block is confirmed. And whenever price trades into this zone, you can what? You can take a sell from there. You understand? Now let's go to our next slide, or this is the market's time cycle scan. Now you all know that the market opens on Monday and then closes on Friday. But within this week, there are actually specific days that the banks take their trades. How? Now you can see that Wednesday is when they open new trades, and then Tuesday is when they close those trades. So actually for them, the market starts from Wednesday to Tuesday the next week. So now, if you are doing your analysis, you have to consider, you don't have to consider from Monday to Monday or Monday to Friday, but rather from Wednesday to Wednesday. That will give you the good or the accurate trading range of the previous contract cycle. You understand? But now, on Wednesday is when they open their trades. Now, if banks open their trades on Wednesday, it means that Wednesday is actually a zone where you can get a lot of orders coming into the market. Now, two things happens on Wednesday. Either they accumulate orders or they tap into a key level. As I said, two things. Now, when you see accumulation on Wednesday, that's a very good, start of the week. Now, let me go to Friday. Now, Friday is when they do reaccumulation or re-evaluation. What they do is, now on Friday, they will assess the market and read the order book and see whether they should continue holding their trade from Wednesday or they should reverse, their trend. So if you see that Wednesday trend, so at times you can see that when Wednesday can be trading, can be having some trade on Wednesday, then on Friday market will rest. That means that they've changed their mind to do something else on what on Friday. So now this is actually the logic behind Wednesday and Friday CRT. Now on Wednesday, most of the time they will accumulate on Wednesday. Then what happens? You know that this Wednesday and there has been what accumulation. That means that above this and below Wednesday zones are what liquidity pools. Because actually, if banks are placing trades on Wednesday, it means that highs and lows of Wednesdays are what liquidity pools. There's so much money on Wednesday. Now on Thursday, this is what they will do on Thursday. Now on Thursday, what they will do is they will now sweep one side of the market and get the other side of it. So on Wednesday, what they'll do is that, sorry, on Thursday, they will peg one side of Wednesday and then write the other one. Now, this is how the liquidity pool and inefficiency comes in. You know that on Wednesday, there are what accumulation here. So probably you get some high and low. So now this high and low has become your fractal points. It means that above this highs, there was liquidity. So when on Thursday we peg this high, over here, that means that we are going to look for volume confirmation in the form of order block or a fair value gap. So when you see those things happen or form here, then to me that your trade is confirmed. Now you can trade or can enter from a fair value gap or an order block. Now another thing to that they will do is that if they accumulate on Wednesday, probably there will be a key level either above or below. So on Thursday, they will sweep this high and tap into that key level before what going on their intended trend. Now let's go to the chart so that I can illustrate it very well for you to see. So on the charts, this Euro USD. Now this Wednesday high low, Thursday we swept the low, then Friday distribution, Friday range, Monday we took the high, then Tuesday distribution. This Wednesday, Thursday we took the high, then Friday distribution. So you locate the Wednesday high and the Wednesday low. Now you wait for one side to be pegged on Thursday. Now the most probable way is when you actually get an order block that price taps into. Now for that one, you can actually even catch the trade on Thursday before Friday. I think on the 4 hour there's some other block over there. So when you go to the 4 hour, I'll show you. Now on Friday, you can see that I have a key level here, a high time frame key level. That's where Monday tapped and then what from a CRT with Friday range. Then Tuesday, you actually what expanded. Now on Wednesday too, which is this previous Wednesday, the same thing. The range was formed. And on Thursday, we tap into this fair value gap on the daily time frame. This fair value gap on the daily time frame. That means that you can actually catch it on Thursday and then continue the ride on Friday. But for the beginning, I will advise you to skip, the second ones and wait for it to form before you go to the next, candle. Now on 4 hour like this, let's see, on 4 hour. Now we had an order block over here. This candle is another block. Why? Because the candle tap into a fair value gap here. Is a fair value gap. And this candle tap into this fair value gap. And this the candle that tap into the fair value gap was displaced here. That means that this is our order block. So that candle is an order block. Now this is a candle that Thursday tapped into. After sweeping this liquidity that was formed on Wednesday, as I said, the institutions placed trade on Wednesday. So it means that the highs and lows are all full of liquidity. So now this fractal low will be our liquidity pool. So we swept the liquidity pool into an inefficiency zone, which is this order block. Then price started was rallying up. Now from Thursday we started the up movement, then continued on Friday. Now on Friday too, we tap into a key level. Now whenever we tap into a key level, that's when you evaluate price action and see whether we are going to continue the trend or reverse. So as you can see, Wednesday, Friday range high and low, Monday to the high over here dropping. Now our target is Friday low. On Wednesday too, which is this current Wednesday, the same thing. Wednesday's range was formed, and then Thursday we swept the high into a key level, which is a fair value gap. Yeah. And this fair value gap aligns with the daily fair value gap. With the 4 hour fair value gap, we type into it, and then we had a bearish reaction over here. So from here we started dropping. So this is where we caught all those trades. Now I sent out all these trades to my Telegram channel. So if you want to join, the link is in the description. You can join. I give out daily bias, open my trades. I send everything to the channel. So I called out this trade. I think I called out this buy. I called out this sell. I called out this sell too, and then this sell. So everything is my Telegram channel. You can watch everything. Now I think let's go to GBP USD. Also the same thing over here. So this Wednesday, I think I've notated this one. This Wednesday's low, expect. Wednesday's high. So Wednesday, Thursday swept expansion. Friday, Monday swept expansion. Friday, this one the target has not been hit. Friday target, Friday low is still in place. Now Wednesday, for this Wednesday high and Wednesday low. Understand? Wednesday low. So we swept the high, and then Friday we are what? We are continuing. Now next week Friday, since Friday, since Friday is continuing the move on Wednesday, it means that on Monday we will still sell, probably into this zone over here. Understand? So all that I was saying that for this model, locate locate Wednesday high and low, and if possible, try to find or look for key levels above and below. Now when we sweep one side and tap into that key level, you can take a trade from that key level. You can take a trade from that key level. Then from there, you can ride it. Now, as I said, I sent all this to my channel. I sent all this to my channel. So this is um So I cut out all these trees. I cut out